really stellar earnings growth, then where do I not want to be?
Well, I'm not saying really stellar earnings growth, but just positive earnings growth for the first time in a long time. And I think if we were calling for an everything rally, we would be pounding the table on maybe the small and mid cap complex. But for now, we're somewhat agnostic between that part of the market and the larger cap part of the market. We do still think, that Magnificent Seven cohort can do a lot of the heavy lifting and likely post stronger growth numbers than the remaining.
So that Magnificent Seven right now is a trending word. It just means the top 7 players of the S&P 500. And what you're seeing right now with them is there's been a divergence between them and the rest of the market. There's a little bit of churning, or the rest of the index, I should say. A little bit of churning within that index. I think that a lot of, they're bigger names, and I think that a lot of retail investors, not to be confused with institutional investors, are just putting some of their their change in, and it's driving up the prices a little bit. But there's only so many buyers before everyone's a seller, right? So you gotta kind of watch out for that. But again, and I've been saying this, I'm going to be kind of a broken record of this kind of time, right, when we're in this period of time in the market right now, is that you're going to need to see productivity levels go up. Right now they're at all-time high, but they always increase, right? You're going to need to see employment levels stay where they are or do better, and there's been a little bit of negative data recently to kind of look at that, and those are key aspects. You also want to see the Fed lower rates, and you want to see these companies have good earnings, right? And without that, it's going to be a little difficult to keep on getting these high multiples, right? But that doesn't mean don't invest, right? But it's just a little concerning. That's all.
493, but I think a broadening of the rally and some degree of rotation should be expected in the year ahead.
Samir, how do you see it?
Yeah, I mean, look, I think you've got to kind of continue with the hot hands, right? I mean, we like comm services. That's probably the most reasonably priced of the 3 growth areas. We recently upgraded consumer discretionary. That's where you've got your kind of EV players and your e-commerce players. I think you've got to have a full weighting there. I think you have to have a full weighting in technology, right? That's kind of the epicenter where all this spending is happening. And then I think there's others.
And I don't think discretionary is going to do that well like it has in the past. I think the time for discretionary, if it was probably at 21. There's some families that are making good income and they're doing well and they can do discretionary spending. There's a lot of people just scraping by, but I saw someone in a previous video talk about consumer staples, and that would be a pretty nice hedge if the market was to do a downturn. By the way, this is not at all financial advice. I'm just talking. I am a financial professional, so I'm kind of limited to the things I'm saying. I'm just talking about where we are in the markets right now, right? So, I'd like to get more about how these systems work. I'm always open to chatting with whoever wants to on Twitch and have a discussion on this so we can kind of see how these system works. So, if you think the market is headed in a certain direction, right? If you think the market is headed in a certain direction, what could I invest in if I want to do that type of investing, right? It's always it's my professional advice. It's always probably better to have someone manage your portfolio, but if you want to learn or tinker or something like that, we could have those discussions, right?
spots too, right? We like energy, right? If you're going to have all this AI power generation, it's going to be powered, at least in the
Energy
short
would be
term,
good.
probably by natural gas, right? So energy has a much cleaner story than it has in recent
they're
years.
talking about
We like
buying nuclear
industrials, we
power
like
plants right
financials.
now.
Both of those
Some
have
of
to do with
some
kind of the
tech companies.
financing of AI and just the economy more broadly, along with just building out those data centers and that electrification. And so, again, I think there's a lot of different things that are working. Probably the only thing we would fade would be emerging market equities and defensives within the U.S. because, again, I think there's a lot of growth in other places.
Are you expecting that the run we're seeing late year in mega cap is going to have a January effect? Once the calendar turns, we start thinking about some tax selling and things of the like?
I've definitely heard.
So there's a lot of tax harvesting that goes around this time of year that has to do partially with a lot of the rallies, this quote-unquote Santa Claus rally that we see around this time. So that's what he's referring to.
Heard investors, talk a little bit about waiting until the new year to take gains, but I think the way you want to go into the next year is a lot of people are waiting for that type of opportunity. So I think you go in with those full weightings, and I think honestly, if there is a pullback, you probably lean into that to add to some of these areas because again, I think pullbacks will be very short and shallow, especially in the first half of next year when all of this positive.
And I agree. I think that when everybody's waiting for a pullback, there's a lot of people ready to jump in. Right, so if you see a pullback and there's not an immediate jump, it could be something a little bit greater. But there are tons of people right now that they took some cash, they put on the side, and they're waiting for a pullback. But there's so many people that are doing that too. You're gonna have a real good jolt because a lot of people are just trying to jump into these smaller declines. But that's not and I don't recommend that type of trading for anybody. I'm just saying that this is the type of behavior that we're seeing right now. Dollar cost averaging is always best, right?
Activity kind of plays itself out.
Is that what you think, Elise, that you're going to get, if any pullback is just going to be bought because there's all this optimism about what a new administration is going to mean, deregulation, tax cuts, higher growth, more investment in the U.S., all the things that we hear about almost every day now?
It certainly seems to be the case, at least on the equity side, but we're looking across asset classes for opportunities as well. In core fixed income, it's probably going to be carry-like returns in the year ahead, but especially given how hard the equity market has rallied this year, last year, we also want to look for other ways to renew portfolio resilience and make sure we're kind of fleshing out the full portfolio.
And you could do that with your own portfolio too. If you feel like hey, we're at an all-time high, you could talk to your financial advisor, ask to add more resilience, more beta, or some more negative correlations into your portfolio, right? But beware of those fees, though.
Would we be foolish to think that we could have another banner year in stocks because we've had two in a row?
It's happened. The problem is after you've had 3 years in a row of really strong returns, what has typically happened is very poor returns in the following years. So if we get another year of 20% plus returns and it's mostly driven by multiple expansion as it was this year, you do run the risk that forward returns would drop precipitously. And so we do have to be aware that things like leverage are picking up a lot in this market. And this is one thing that could keep people from being able to buy the dip. FINRA margin loan debt is up 45% year to date. You're seeing leverage ETF buying, options buying, all suggesting that people are starting to take on a lot more risk. So down markets are not as easily digested.
Basically, she's saying people are using a lot of margin on their account, which is always a scary thing. That's it for that one, man.